Good morning. How you doing? Hope you're well. It's Friday. It's Friday the 16th. What are we talking about? This is what's on the agenda. AI gets an overdue electricity bill. China tells its flash boys to slow down. And it's a long weekend in America. But yen traders probably won't get a break, Tom.
Asian stocks are on the rise. South Korea is doing a lot of the heavy lifting. The Kospi is gaining across the benchmark, gains of 0.3%. China under pressure on that story around the flash boys of China. Some changes there. European futures pointing low by 0.3%. But with the context that you've seen gains, year to date of 4% for the benchmark in Europe and a fresh record yesterday. US futures pointing higher by 0.3%, looking to build on the modest upside that came through on Thursday. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. It is Friday, the 16th of January. It's just gone 7 o'clock here in London. Let's get to our agenda, and let's start with the question of whether we need to worry more about prices than we do about jobs. You see this evidence in the Fed conversation. You see it evidenced in the Trump administration's priorities. They're clearly putting affordability front and centre. And today's example of that is around electricity prices. Guy, you summed it up saying this is now going to become the tech sector's problem, and it is the tech sector that seems to be driving that incremental demand. And so now President Trump and governors in the northeast of America are aiming to get tech companies to fund new power installations. And this just the latest part of the Trump administration's agenda to tackle affordability.
President Trump was very clear. He wants to make sure that we have data centres in the US, but it is not residents, it's not homeowners, and it's not small businesses that are taking the cost. We have seen that increase in prices. Bloomberg's own reporting towards the end of last year pointed to examples of residents living close to data centres in states like Virginia, where they saw increases of close to 270% on a month over a 5-year period, above prices 5 years previously, 260%. Overall, in the state of Virginia, you've seen increases in 2025 of about 7 to 8% increases. That is being felt. People are feeling this. And so now you have this push for these utility companies and one major utility company in that northeast part of the US to put out these long-term contracts. And it's the data centers, the hyperscalers and the tech companies that are going to be shouldering the burden.
Thinking about this two ways, one of which is those companies. Does this mean that CoreWeave is going to find it harder to make money? Does this mean that Oracle is going to find it harder to make money? Clearly, the other thing I think is interesting about this is that the Fed and President Trump are largely aligned. Inflation is becoming a bigger and bigger problem, and as a result of which we need to deal with that. They see it slightly differently.
Yes.
But
how far that alignment goes,
but the inflation story does seem to be a bit of an issue for both of them. The other issue is that it just highlights to me once again that China has a huge lead. China has excess electrons. America doesn't. And that's going to be a problem with the AI race. And basically, you do wonder whether this is a story that could slow down the AI story in America. Just doesn't have the electrons to be able to deliver the output that it necessarily needs. And that comes back to companies like CoreWeave. Are they going to be able to make money with higher and higher costs?
And that's where you have to, again, differentiate amongst the AI players, those who have the balance sheets and the ability to pass on margin and costs to their consumers versus those who are already heavily leveraged, like CoreWeave, and are now taking on potentially 15-year energy contracts that they'll have to commit to. You mentioned China, and there is this story, pretty interesting, and it's a reminder of the Chinese regulators and the Chinese government's determination to ensure stability everywhere, but increasingly in the financial markets as well. You've seen a run-up in the Shanghai Comp of over 20% in the last 12 months. Now the detail around potentially what we're seeing, well, we know this is going to happen. Regulators pressuring the brokers in China to remove some of their capacity in data centers sitting alongside the bourses in places like Shanghai and Shenzhen and Guangzhou, so that those high-frequency traders, they will not have that proximity, those millisecond proximity to the bourses in terms of the data flows. They want those pulled out, I think, in the next 4 weeks or so.
I think the Chinese are looking at America and going, your whole system is now geared towards financial markets. Does the Fed serve the American people, or does it serve financial markets now? Are there excesses in the financial system that pose a huge... China's just been through a crash in its housing market, probably doesn't want to have a crash in its financial system. And it's looking at America going, yeah, we're learning some lessons from what you guys are doing now.
Well, if anybody thinks they can remove boom and bust, then maybe China thinks they can have a go at trying. We'll see. But yes, this will impact retail and institutional investors, which I thought was interesting, because we perhaps think of this, the Flash Boys made famous by the book, of course, and we think of this as maybe a feature of the institutional environment in the States, but it's actually a real retail thing as well. And certainly in China, that is the case. So we'll watch this. And this coming on the day that we've seen, yes, another high for Asian stocks.
And the volumes are epic in Asia right now, going through some of these financial markets.
South Korea,
And it's interesting as well that it's feeding through into the metals market as well. So there's a kind of, you could start to see understand the connections that exist within some of this financial plumbing. So it's a long weekend in America. It's Martin Luther King Day on Monday. So that's a great opportunity if you want to intervene. If you're Japanese,
if you don't want to fight the US view of anything,
light volume, and you want to intervene, and I find it fascinating. The Japanese authorities are actually quoting the deal they've done with Besant as well, and saying that was part of the deal that we make sure that the currency doesn't appreciate too much. I thought it was quite a decent. Ven Ram on the MLI disagrees with it. I thought it was quite a normally intervention chat. Jawboning doesn't really deliver much of a response. I thought it did this morning. And that tells you maybe that there is a slightly higher expectation that it's possible this time around.
For how long is the question?
Yeah, because we were saying earlier in the week, I mean, it only ever does the window dressing, doesn't it? It doesn't really do the fundamentals. But the dollar up by 0.2% against the yen. So the finance minister repeating, that all options are on the table. And so then you're into this conversation, is it about intervention? Will it happen on Monday? Does Scott Bessent actually want to see the BOJ take more action? And this was something that the Japanese left out of their readout of the meeting between Bessent and their Japanese finance minister. But Bessent has been talking back in October. He was talking about whether the government needed to give the BOJ more space to fight inflation. You wonder what he sees as the role of the government when it comes to monetary policy setting in that context.
The BOJ expected, of course, not to move in a rapid pace, and we know that the politics is going to constrain them. That seems to be an analysis from our team in Tokyo. Until you get the elections out of the way, then really Governor Ueda is going to have to be on the sidelines in terms of that thinking around higher rates from here. But with all the fiscal stimulus that's expected and what it's doing to the yen, does it pull forward at least the market's view that the BOJ has going to have to be a little bit more aggressive in terms of upward hikes? And also what that means in terms of the rate differential with the US.
All of these things. Bessent was talking about the Korean won this week, so he's paying attention to Asian currencies.
Certainly, FX in focus. We will put FX in focus. We will also talk about the trajectory for the US economy. How enthusiastic should we be about US stocks, about global stocks? A good time of year to check in with Chris Watling, Longview Economics CEO. He was very pleased with what he saw in global equities last time we spoke to him, so we'll check in with him. Jane Foley, Rabobank FX strategy head. We will certainly talk to Jane about the yen and what she expects or doesn't expect for Monday, and intervention watch more generally. Patrick Armstrong will be with us, Plurimi Wealth CIO. So we'll talk there about big tech exposure and what his latest thinking is. Jessica Apotheker will be with us, Boston Consulting Group senior partner, to talk about tech from another angle.
On your daybook, other things we're watching today. Prime Minister Carney is in China. We are seeing, and we've been getting details of this agreement they have been making, and we're looking at things like agriculture, of course, and energy. 2:15 p.m. UK time. Meanwhile, we're going to get some data out of the US in terms of December industrial production, so we'll be breaking that for you. And US senators in Copenhagen, of course, as conversations and the pressure from the US continues vis-a-vis Greenland. So we'll be monitoring that for you as well. And later in the day, we've heard from Fed officials already through the week, and we've been discussing the emphasis switching, it seems, from the jobs market to the inflation story. We're going to be hearing from more Fed speakers, including Bowman, Collins and Jefferson through the day.
Yeah, I thought it was interesting that we heard from Daly and we heard from Paulson, both of whom had been fans of cuts in December, but now signalling a pause. So the fact that we got those who were not fans of the cuts last time around, signalling a pause may be less meaningful, but that does seem to be the direction of travel at the moment. Lots of people in the Fed talking about pausing, about how policy's in a good place, they're comfortable with leaving rates steady. Doesn't seem as if there's any great hurry to move towards cuts.
The claims data yesterday was really strong. Can we park the labour market concerns for a while and focus on inflation? That seems to be the shift that the Fed is going through at the moment, all of these Fed speakers are talking about. The Fed's only got one hike in for this year, if you look at the dots. The market's got two. So therefore...
Cut.
Sorry, cuts. Did I say hikes? Maybe I'm just getting a little ahead of myself.
Yes, you get confused
Maybe
these
next year,
days.
27.
Yeah.
Do we move towards 1, and how quickly do we move towards 1? The US 10s are kind of 216 right now. We've been threatening the top end of the range. Do we break through that? How quickly could we do that? I don't know. The data keeps moving. If the inflation data increasing becomes the focus, do 10s need to break out to the upside?
416, 56. What on earth breaks us out? Maybe something at Davos, who knows?
Yeah. Well, our team, President Trump is going to be there, isn't he, at some point, making a speech. But our team have been reporting on some anxiety in some parts of the markets in terms of the lack of volatility in the yield and how little it's been moving, the tight trading range.
The range is amazingly tight.
And that typically over a period of time, that will break out and there's potentially a sell-off on the horizon. But the commentary from the Fed officials is fascinating, and a jobs market that adjusts. 4.4% is the most recent unemployment print, and we're not seeing a huge impact from AI. In fact, wages for junior lawyers, for example, have gone up, and there's a need for more radiologists in hospitals. So the AI impact that some had foreseen on the jobs market isn't really coming to bear in terms of a risk for eroding the labour market in the US.
Phew, excellent. Good.
Yeah.
We're done with that then. Don't have to worry about that now.
I think not. OK, what else do you need to know this Friday morning? A US judge has ruled that Norway's Equinor can resume building its multi-billion-dollar wind project near New York, marking the second time this week that a federal court has blocked the Trump administration from enforcing a halt when it comes to offshore wind developments. Equinor had argued it would likely have to cancel the project, which is 60% complete, and intended to supply more than 500,000 New York homes by 2027. Electricity again, front and centre. The US and Taiwan have agreed to a trade pact that would lower tariffs on goods from the self-governed island to 15% and see Taiwanese semiconductor companies increase financing for American operations by $500 billion. Under the terms of the duties on Taiwanese shipments, they would fall from the previous 20% rate, putting them on par with Japan and South Korea, which struck their own deals, remember, last year. And Iran has pledged not to execute protesters after pressure from President Trump. In a post on Truth Social, Trump wrote that Iran's decision not to sentence protesters to death is good news, and he hopes that it will continue. Meanwhile, at least one US carrier group is moving into the Middle East from Asia. Fox News reporting this, citing military sources. The cable news channel also reported that other US assets are expected to be flown into the region in the coming days and weeks. Keep an eye on the oil price.
Yes. Can I just meditate on the human impact just for a moment? Because I spent a lot of my time in China. Yeah. And China's modern image has been seared by the massacre in Tiananmen Square, where around 3,000 people are thought to have been killed.
Yep.
In Iran, that is the number now, a little north of 3,000 people. So President Trump has been watching this, and we're seeing now US assets moving to the Middle East. Do we need to start, on the day when oil is down, do we need to start to reassess where the Trump administration goes? We're also thinking about how other players in the Middle East have been weighing in on this.
Yeah, well, maybe oil traders thinking similarly, because oil just ticking up a little, actually, up by 0.1% or so, 63.86. Interesting that we started the year just a little north of $60 on Brent. We're now at 63.86. So even though Venezuela gave us a lot of pause for thought about where the oil price was going to go, because there were such conflicting signals in that particular drama and dynamic. But since then, the pressure has been upwards broadly. I mean, yesterday we saw a big drop because of the Iran story, but that doesn't feel as if it's gone away.
The rest of the region's clearly worried about the fact that if Iran is hit, it could strike back. The Iranian authorities feel like they've got their back against the wall. What happens next is for the oil market, feels pivotal. So much oil comes out of this region. So much of it goes through the Straits of Hormuz. This could change on a dime, and I don't know how you price it. With President Trump kind of managing the situation, I use those words carefully. Anything could happen, and it could happen really quickly. So again, going into a long weekend, what do you do? Could things change this weekend? You've got a carrier group that's moving into the region. How quickly is it on station? How quickly could it be operational? I don't know the answers to all these questions. But if energy prices start really moving around, the ripple effects into the global economy are going to be massive.
Coming up on the programme, we'll get back to the corporate agenda. Ford is reportedly in talks with China's BYD about its battery supply. We'll have the details of that. Plus, US lenders hit a trading record in a very eventful week for bank earnings stateside. We'll get some analysis, look ahead to the European bank earnings story as well. And up next, Asian markets get a boost from the tech trade. We will talk markets. If you have any questions for our guests, please do get involved. IB plus BBTV Go. That's the function to use on the Bloomberg terminal. This is Bloomberg.
Welcome back. Friday morning, 42 minutes to go until equities start trading. Cash equities start trading here in Europe. Futures are pointing us largely in a negative direction. Yesterday was an okay session. The US sold off a little bit towards the end, so I suspect what you're seeing on the screen in front of you is a little bit of pricing of that back-end sell yesterday. Asia continued to respond overnight to the TSMC story that we brought you this time yesterday, so you can kind of park that one and put it in the rear-view mirror. Claims were good yesterday. I don't know what gives us the next leg. Is the rotation story good enough to get US indices higher? We're going to park that one and come back to it, I suspect, in just a moment, Tom.
It is a mixed picture on the Asian equity scene. On the benchmark, you're seeing gains of around 0.3%. It's the Kospi is doing a lot of lifting. And then we got the story in China about authorities there pressuring some of the brokerages to remove servers dedicated to high-speed traders. That's weighing on mainland stocks and Hong Kong as well. Let's bring in Winnie Su, who's standing by in Hong Kong for more on what is rippling through the Asian markets this morning. Winnie, what stands out to you?
Yeah, exactly. Like you mentioned, Tom, we actually had a pretty decent week in Asia as we're headed for our best week since September. And like you just mentioned, it's mainly driven by these gains in the technology sectors. We're talking about the Taiwanese benchmark and the Korean benchmark, both refreshing record highs on that solid earnings from TSMC, and also tariff agreement with the U.S., between U.S. and Taiwan. Now, here for cross-asset-wise for the Japanese yen, finding a bit of a support here with the Finance Minister Satsuki Katayama warning of the yen's weakness and also noting that agreement with the U.S. in terms of potential currency intervention. But we'll be closely watching for the Bank of Japan's rate decision next week. Now, flip the board, as you just talked about how that big news in our region is around Chinese markets, seeing how across the board it's all in the red. And that's driven by how China said that it's now clamping down on high-frequency trading, and they are asking these local exchanges to remove servers of these clients away from the data centers. Now, these traders really want to have their servers as close to these data centers as possible so that they can execute trades as quickly as possible. And hence, you're seeing quite a hit on the brokerage sector because of how these traders now might have to tweak their strategies and that they will have to potentially reduce their trading frequency. Another sector that we're seeing that's taken a big hit here is the commodity sector, specifically those listed in Shanghai. We were just talking about how copper, tin, nickel, all down, and also with these metals related sectors, stocks listed onshore as well. And that's also coming after how the metals platform, the Shanghai Futures Exchange, is also telling their brokers that they have to remove the servers of these high-frequency traders by end of next month. Back to you.
Winnie, thank you very much. Winnie Su in Hong Kong. Let's talk about where stocks are trading and bring in Chris Watling, who joins us today from who's global economist and chief market strategist at Longview Economics. Chris, great to have you with us. Last time we saw you was December. Feels like a very long time ago, isn't actually? You talked about stocks looking like a great-looking beast, which was just noteworthy.
Right.
Do you agree with yourself from December?
I do, yeah,
Still?
I do agree with myself. I haven't changed my mind over the Christmas festivities.
Mm-hmm.
I mean, the global macro looks terrific, and we've been talking about this idea of a global economic acceleration in 2026 that we're starting to see, I think, and the broadening in global markets is coming with that. And the Fed's cutting rates, and they've stopped doing QT, and the earnings look great, and so the basic macro backdrop looks absolutely terrific.
Okay, not too terrific though. I mean, we've started asking questions this week about whether things might overheat.
Yeah, I mean, we're a long way from overheating. I mean, you look at US bank credit, it's growing at 5%. Overheating would be 10% or 12% or something like that. I mean, we're just heading in the right direction. I mean, having said that, I mean, there is building complacency in markets. So, you know, markets go up in the long term on macro, but they trade off on complacency and exuberance in the short term. I wouldn't say we're quite there yet, but I think we're moving towards that kind of point.
Is inflation a bigger threat than the job market?
Actually, I think inflation surprises to the downside this year. So I think that's going to be it adds more to the macro case and more to the idea.
Why do you think that? Because a lot of people don't.
Because there's no real inflation out there. We had sort of tariffs last year distorting everything. If you look at the US, rents at 1%, house prices are basically at zero. Yep. The labour market's easing, oil prices down on 12-month. I mean,
Chris, AI is inflationary. across the stack. You look at the data center build-out. We've got a reminder of that today. Are you underestimating the inflationary impact of AI?
AI is inflation across the stack. Well, that's great. I mean, it has some inflationary impacts, but I would argue we've got a deflationary productivity boom coming.
In 2026?
Driven by AI. Yeah, I mean, I think some of the job losses are happening already, and some of the applications of AI into real businesses are extraordinary what they can do. So I think it's actually really adds to that case of disinflation, as does China. I mean, the Chinese economy is a mess. I thought it would do much better last year than it did. And we had the trade surplus in China last year. It was giant. Yeah. There's no imports and tons of exports.
So, and clearly we're heading towards the midterms. Last time we've also talked about how the midterms has a role on markets. President Trump is clearly focused on affordability, isn't he? And
yes.
So do you think that inflation is not a problem because you think he will be successful, perhaps, in some of his policy initiatives in limiting price gains?
Well, maybe. I mean, clearly that's his focus, absolutely. No, I think inflation is not a problem because half the economy is not really doing anything. It's really soft and there's loads of spare capacity. But, yeah, the midterms are a really important point because actually the midterms are normally a rocky year for markets. And we remember 2018 under Trump, and 2022 was a bear market. So actually, the history of the midterms is quite troubling in terms of pullbacks. So, yeah, look, Trump's up to all sorts of stuff.
Where is the market most complacent?
Where's the market most complacent? Probably in the cyclical stuff for now. I mean, that's the stuff that's been moving hard.
That's rocketing at the moment.
Well, of course it does, but that's what it does.
Yeah, but that's the wrong trade, right? So I'm
not saying it's the wrong trade yet. No, I'm not saying yet. Yeah. We're still overweight, long, everything's great, but it's building towards a problem. And I don't know whether it's the end of Q1 or early Q2. Well, you get a pullback and you get a refresh and a reset, and then we go again. But no, don't get me wrong. By the end of the year, equities will be higher, probably, but it's going to be rocky.
Yeah.
It's going to be difficult.
Chris, do European stocks continue to outperform? The outperformance 4% year-to-date versus 1.4%, 1.3% for the S&P 500. Does that outperformance for European equities continue?
My suspicion is it's going to flip and tech's going to outperform this year, and the US is going to outperform.
By tech, do you mean Mag 7, or do you mean different parts of the tech space?
Mag 7, tech in general, all of the above. I think the leadership's going to shift at some point. Tech's very oversold relative to the market at the moment, and it's still a source of good earnings growth, and it's still a great story. We haven't had the full bubble, and we need to price that in.
Yeah. In search of these areas of complacency, what about credit markets? We have a great story on the Bloomberg this morning saying we've got the hottest credit market since 2007. This is really tight spreads. Yeah. Are we underpricing risks there?
Well, I think that's a terrific point. I mean, they're hugely underpriced, aren't they? And if you think about the bottom half of the US economy at the moment, it's not that great. And spreads, as you say, they're basically as tight as they've been since 2007, which is an awful long time. And they almost never get tighter if you look at high yield. So yeah, I do think that's a great example of complacency.
Yeah. How does that fix itself?
Well, this is part of the risk on, risk off, and they'll get caught up in that when that happens.
What does risk off look like? This is the bit, because the market doesn't want risk off. The US upper end consumer doesn't want risk off. How much risk off do you need before risk off becomes an issue?
Good question. I mean, no, I'm just talking 5 to 10%. I'm not talking major risk off.
Okay.
Yeah.
So this is just a wobble.
Well, you can call it a wobble if you like, but you can make a lot of money if you trade it well.
Okay.
Both sides.
So it's a good year for traders.
I think it's a good year for traders. I mean, there's a lot of fun stuff happening out there.
Okay, a lot of fun stuff. We'll leave it on that point.
Yeah.
Chris, nice to see you. Chris Watlake, Longview Economics. Coming up, yen traders certainly watching out for renewed volatility. Uncertainty over Japan's snap election grows. Jane Foley from Rabobank joining us next to discuss a long weekend in America. This is Bloomberg.
Happy Friday, 30 minutes from the start of the opening trade. You're getting a bit of a mixed picture in terms of the futures for Europe and the US. US pointing higher in the green. European futures, though, after a fresh record high yesterday, pointing a little lower right now. We'll see if that holds. Down 0.2% on the Stocks 50 futures. Here in the UK, FTSE 100 futures pointing lower by 13 points. And over in France, the CAC 40 is just lower by a little shy of 0.2%. But again, it's been a good year for European equities year to date.
Yes, 16 days in, and it's been a good year. Bonds, let's check in where we are on the bond market story. And we have yields sticking a little bit higher in European bond markets this morning. Not really by much, though. Not much to see here. And a lot of our focus over the past 24 hours has been on the credit market story and the tightness of the spreads and the fact that the market still has the appetite for government bonds in the context of all of the supply that's coming from corporates. That's being remarked on quite a lot. Guy, I can tell you this morning over in Japan, yields are a little bit higher.
Just a little bit.
Up by 2 basis points on the 10-year.
OK, that's a little bit. I think we'll take that as a little bit. Let's kind of widen the lens there a little bit and talk about kind of what we've seen over the last 30 years when it comes to Japan. Now, think about the last 30 years. Inflation has gone nowhere, virtually at a standstill. Now we've got this weak yen. That's changing everything. Here's how consumers and businesses are coping with rising costs and what it means for the future. This is from Bloomberg's weekly documentary series.
In 2016, this Japanese company issued a public apology. For the first time in 25 years, they were hiking the price of a popular ice cream by 10 yen, or about 6 cents. And they were deeply sorry. Now, in any other country, this might have been an overreaction. But in Japan,
inflation is just completely alien as a concept.
for 3 decades, the country saw stagnant or even decreasing prices, which is why a 10 yen price hike for an ice cream was such a big deal. But a huge slide in the yen is helping change that picture. And it's causing a seismic shift in Japan's economy. The yen has weakened against the dollar to a level not seen since the early 90s.
The weaker yen means higher prices for all sorts of imported goods, from groceries to gasoline.
It's also making it pretty attractive for inbound tourists looking for a cheap vacation. Steering the country through this once-in-a-generation cost of living crisis is the inaugural challenge for Japan's new leader.
Sanae Takaishi has been voted in as Japan's first female prime minister.
Japan has arrived at that big moment where there's a potential transformation of the entire society.
Big things are happening in Japan. You want to get the full version of that, and it's well worth a watch. Go to the Bloomberg website. You can find it on YouTube as well. Let's show you quickly what we've been watching this week in terms of what the yen story has done. We continue to weaken. I think that's the real trend that we are watching here. If you look at the fact that we've seen the yen moving, I guess on a weekly basis, on a 50-day basis, not a lot, but just the trend is there and clear. And we're going into a weekend when I think a lot of people are very alert to the possibility that we could have intervention. We've already heard the finance ministry talking about it. You've got a 3-day weekend in the United States. That means an opportunity maybe for a bigger bang for your buck when it comes to the Japanese authorities. Jane Foley, Rabobank FX strategy head, joining us now. Jane, long weekend in America this weekend. They got Monday as a holiday. Do you think yen traders will be taking a break?
Well, I think anyone who's got anything to do with the yen will be wondering if this is going to be the time when they do intervene, because I think we all know that the finance ministry can threaten, but unless they put their money where their mouth is, and eventually those threats begin to be a little bit damp. So they will at some point have to follow through. That said, I think we also know from experience that intervention really only has a proper impact in maybe turning the currency pair around if, and maybe with hindsight, we can say, oh, yeah, you know, the fundamentals were changing at the same sort of time. And I think for the market to really see this intervention, if it does come as a turning point, perhaps we need the Bank of Japan also to be even more hawkish. Now, Ueda was hawkish over the new year, but most of us were on holiday. And I think we need to have a step up in that hawkishness for this intervention, assuming it does come, to really have a grip in turning dollar yen around.
Do you think the US Treasury Secretary is going to be having a long weekend? Do you think he could play? Do you think this could be coordinated? How possible would that be?
Well, you know what, that is interesting, because there is that suspicion out there right now that it could be coordinated. Now, of course, we've had this before. I seem to remember it around about 1998 under the Clinton administration. We had coordinated intervention. So there is a precedent for that. But we also know, if we look at some of the commentary from Scott Bessent, for instance, over the last few months, you know, he said, you know, that the Bank of Japan really does need to hike interest rates. And his view back then, he was saying that the Bank of Japan is behind the curve. Now, he was looking at headline CPI inflation data, which is pretty high for Japan right now. But of course, the Bank of Japan has its own measures, its own readings of underlying inflation. They're going on the back of those, and therefore they're going at their own pace. I mean, you've got to remember at the end of last year, they had to work out the impact of US tariffs on the economy. You could see that in some of the balance sheets for some of those big Japanese firms. They had to absorb the impact of tariffs. So there have been issues, there have been political issues, obviously, in Japan at the end of last year too. So they're going at their own pace. But will they be prepared to step up the pace of rate hikes? I think that's probably what Besant wants.
What do you think would pull them off the sidelines, Jane, in terms of the BOJ, with that more hawkish stance in terms of higher rates?
Well, you know what? I mean, right now, economist surveys are suggesting that the Bank of Japan may not hike interest rates again until July, possibly April, something like that. But, people aren't confident in it until the middle of the year. I think what the market really needs to see, what economists really need to see, is stronger data. Now, we do, of course, have the spring wage talks. They have been pretty firm in the last couple of years. And it's really interesting because you do see Japanese employers groups pulling alongside both the government and the Bank of Japan to try and get these higher wages into the system. They acknowledge that higher wages means stronger consumption, means stronger profitability, and you have this virtuous cycle that the Bank of Japan have been chasing for years. And there is evidence that that is becoming a little bit more entrenched, but we need to see more firmer wages again, but also that coming through into real wages, which we're not really sure about just yet.
Jane, is the yen still a safe haven currency?
I think that's really interesting. If we look at the best performing currencies last year, the yen was virtually at the bottom of the table, apart from the US dollar. And at the top were the Swedish krona and the Swiss francs in terms of best performing G10 currencies in the year to date last year. And if we look at the Swiss franc, which of course is an established safe haven, if you look at the Swedish krona, they are countries which have really strong fiscal positions. And, I do think that what was really hurting the yen last year was the fiscal position, the fact that, the Bank of Japan aren't buying so many bonds, the fact that yields are rising, the fact that it's got so much debt, and the fact, of course, that the new Prime Minister has been associated as a fiscal dove. And I think these factors have been really crucial in undermining the yen. Now, I don't think we can totally dismiss the yen as a safe haven because there's a massive current account surplus, a massive pool of savers that will protect the yen in any sort of crisis. But certainly, I think that position has wobbled in the last year.
Jane, just the finance minister in Japan actually just speaking right now, saying the agreement with the US says that they can intervene for rapid FX moves. So keeping up the momentum of that language coming to market. So we'll keep an eye on what's happening with the yen with that in mind. It's amazing to me that we have such low volatility in FX markets, given all the news flow that has been thrown at them. That seems to be the conclusion of what I've been reading over the last day or so around FX. Low FX vol, one of the quietest Januaries on record in terms of FX vol. How does that sit alongside the news flow?
Well, it is quite surprising, but again, it's not necessarily a new theme. If we look at some of the volatility, well, it did move higher in April when we had those crises in the bond market, the US bond market last year, when we had, the tariff announcements in the Rose Garden, for instance. But since then, it's been sort of trending lower in a sort of a choppy sort of way. And I think the market has become accustomed to such an assault of news flow. And some of it gets pared back by the US president. It never comes to fruition. And I think the market is watching the news. For instance, watching Greenland, watching it, but not really acting unless we actually do see some sort of action on the back of a lot of the rhetoric, a lot of the threats that come through on the geopolitical front.
Yeah, some of our analysis by colleagues seems to suggest following through more often in this term than in the previous term on some of those threats. But let's park that for one moment. Looking ahead to next week, Jane, we're going to get a lot of data out of the UK. Will any of that reintroduce some volatility for the pound?
Well, it was quite interesting yesterday. We had that better than expected November GDP report, and yet sterling didn't really manage to climb much higher on the back of that. Now, I think that's because ever since the November budget, the market has been reducing its short sterling positions. And now, of course, the market isn't any longer particularly short the pound, so we get good data. It doesn't really react. Now, what that does mean is that if the data is strong next week, sterling is perhaps more likely to not react again. So I think there could be a bit of a one-way. Sterling could be hit by softer data more than it could be encouraged by stronger data next week. So we'll wait and see. But it will be quite important. I think the market will be using the CPI data to really form its opinion about when the Bank of England can cut interest rates next.
Jane, if the US 10-year breaks out at the top of the recent very tight range, does the dollar go higher?
Again, I think this is an interesting question based around positioning also, because I think the market has been really caught up in the US is no longer a safe haven because look what happened to it last year. I think that is dangerous to have that conclusion. And I think what happened to the dollar last year was this massive change in position adjustment. The end of this Buy America trade that had been there for years since the global financial crisis. And we have this big change in positioning. And that's meant that the market or the dollar the market's gone into this year no longer long the dollar, and I think this might mean that the dollar can react on the upside to positive news, the news perhaps that the Fed cannot cut interest rates quite so fast. And if we look at the dollar, euro dollar today, back at 116, that would sort of verify that view. So I think there could be some upside potential for the dollar if the US economy appears stronger than we thought it would be.
Jane, on geopolitics, if we get a ramp up in rhetoric from President Trump when it comes to Greenland and Denmark, would you short the Danish kroner?
Well, I think you probably have to short the euro potentially at some point. I mean, obviously, it depends how far this gets pushed. But, the Danish kroner is a very difficult currency to, you could attack it. You could really, try and break that link to the euro. But, ultimately, what is that going to achieve? I think if we came to a worst case scenario where the US just started to land troops in Greenland, I think the euro would be under pressure because I think the logic of that would be, Article 5 of NATO is now meaningless and suddenly Russia becomes a bigger threat for Europe. So I think it's the euro that could, in a worst case scenario here, be under pressure.
Jane, have a great weekend, but keep an eye on the yen. You never know what's going to happen. Jane Foley, Rabobank's FX strategy head. Thank you very much indeed. Coming up, would Jamie Dimon take the top job at the Fed?
Chairman of the Fed, I'd put the absolutely, positively, no chance, no way, no how for any reason.
Okay.
Secretary of Treasury, I would consider, if a president calls you up and asks you to do something, you should consider it. So I would take the call and consider it and think about why and what they want, etc.
He's quite happy where he is. David Rubenstein, sit down with the JP Morgan CEO. We'll have more on that next. This is Bloomberg. $13 minutes to go until the start of trading in Europe. So US equities sold off a little bit into the back end of the session yesterday, and I think we're just pricing that in first thing this morning here in Europe. There's other things going on in Asia, but we'll come back to that a little bit later. Let's talk about Jamie Dimon. JP Morgan's chair and CEO, Jamie Dimon, doubling down on his support for Fed independence. Jamie spoke to Bloomberg host and, of course, Carlyle co-founder and co-chair David Rubenstein.
Everyone I know, including the President of the United States, says we need an independent Fed board. Most people I know, including the President of the United States, speak up about their opinion, which they're free to do. Some say it more aggressively than others. That's their right. The question is only about when certain things take place, and think of lawsuits and stuff like that, does it chip away at that independence? There's some spectrum. So you can say a little bit, you can say a lot, but you don't want to chip away too much, because if you chip away too much, in my view, this is my opinion, it will drive rates higher, not lower. That's all.
You can watch more of that interview on the David Rubenstein Show, peer-to-peer conversations. That is coming up next week. Joining us now to talk about the markets in 3 minutes, Bloomberg Markets Live, Skylar Montgomery-Koning with us on set this morning. Skylar, good morning to you. So despite all the things that Jamie was referencing there, and we had a conversation about low volatility with Jane Foley, we haven't got a lot of volatility in some markets, which is quite amazing. Certainly looking at rates, looking at FX. The one place we do have volatility, though, commodities. I mean, is that going to be the way this plays out, do you think, in 2026?
I think certainly in the next week or so, we're not going to have this kind of jump up in volatility. And it was interesting because I was looking particularly at the 10-year yield, and I noticed that it kind of went into this range in September, and it stayed there. And I think a lot of that has to do with the data. As in, we went into government shutdown in October. We haven't had a clear read on the economy since then, and rates in particular are very much driven by your Fed view. So if you don't know where the economy is going, and you have pricing now where you don't have a cut price, I think, until fully July, maybe a little bit in June in terms of like 22 basis points or something, then there's nothing to really shift around that pricing unless you get a clear view and a number of data prints in one direction, and we still haven't gotten that. So next week, there's still not a huge amount, as in I think we've got third release of GDP and an old PCE print. So I don't think that's what's going to do it unless we get like headlines.
It's Davos next week.
So we could certainly get headline noise.
So is Davos going to do that for us? Trump's going, loads of people are going. It could be exciting.
Yeah, I mean, you certainly could get headline noise on that, and I think that feeds more into your commodity market view than it does into your fixed income view in terms of volatility. Like, I do think at some point rates volatility will have to pick up because it's so compressed. Yep. But you're seeing that these geopolitical plays are coming in the commodity market because people are thinking of it as a hedge. Because we haven't had anything come in with real certainty. And, you know, the weekend's also an event risk in itself in terms of Monday's a U.S. holiday. So you could get announcements from that perspective over the weekend. But I think it's more likely that people keep positioning in gold as a hedge, or you see something actually come through and people aren't sure how sustainable it is, what the impact on the oil price will actually be, given these countries have relatively little supply relative to a 2026 supply glut. And so those volatilities can stay elevated, certainly.
Skylar, what is the sensitivity right now between equities, particularly US equities, and higher yields? If there is that breakout, is that sensitivity still there? And which parts of the equity space would be most potentially vulnerable in that scenario?
Yeah, I mean, I think the sensitivity certainly exists, but in any kind of regime, it very much matters why yields are rising. So if yields are rising because of higher premia, which could be related to Fed independence concerns, inflation de-anchoring, et cetera, then I would expect equities to sell off. If yields are rising because growth is strong, because you're in a strong earnings season, that's very much an equity positive. So I think certainly that sensitivity exists. And you're kind of just getting a grind higher in equities throughout this period where volatility is low in rates, because that's just what equities do. You shouldn't really be selling them unless you have a very good reason.
Are you on Yen-tervention watch? That's our producer came up with that, not me, but I think it's excellent.
Yeah, I mean, absolutely on Yen-tervention watch. The precursor to intervention is always kind of this verbal intervention that you get, and sometimes the market listens to it. And I think what we're really thinking about is there a risk of kind of speculative positioning getting quite big, or a move that's quite large? And so as you get above 160 and you have a kind of clearer level that's not certain, then I think you need to be watching it quite a lot.
Okay, 150 right now in the Japanese yen versus the dollar, up 0.3%. We've been getting more commentary from officials in Tokyo as we lead up potentially to that Monday moment. We'll see, of course. Skylar Montgomery, Carney, thank you very much indeed with the check on the markets and what is top of mind for the team. Let's bring in Jennifer Creary right now with a view on some of the stocks to watch this Friday. Jennifer.
Good morning. We're kicking off with a look at Equinor this morning. That's after a US judge ruled that Equinor could continue building an offshore, multi-billion-dollar offshore wind project near New York, saying that the project would likely suffer, quote, immediate irreparable harm from further delays. Bearing in mind that project is already 60% complete. Listen, this is the second time this week that a US federal judge has blocked the Trump administration's efforts to halt offshore developments. Those shares down 13% over the past year. Moving on to metals, we're taking a look at copper, zinc, aluminium prices all surging in Shanghai and the London Metals Exchange. That's after Chinese regulators clamped down on high-frequency trading, cooling a frenzy over those prices. We can see that those prices have really boosted some shares of some of those metals companies over the new year. Finally, we're turning over to a bit of M&A news. That's after Worthington Steel, the Ohio-based steel processing company, agreed to take over Goldman, the German metals company. Worthington's saying that it sees $150 million worth of, quote, highly actionable synergies. Goldman surging in the pre-market off of the back of that news. Back to you.
Jennifer, thank you very much. Jennifer Creary with the stocks that we are watching. She'll be back shortly to talk us through how those stocks open up at the start of trade. Let us talk about some of the themes that we need to keep in focus as we head towards the market open. I know tech is one of them. Also watching natural gas prices higher, and this has been a bit of a theme. I mean, it's very weather related, as you might imagine, here in Europe, but we're up again 5% on TTF, that benchmark.
And copper down almost 2%. And Guy, you were touching on the fact that maybe some of that price pressure on some of the basic metals seems to be coming through from this decision over in China around high-frequency traders. But there's other factors arguably at play as well. Obviously, copper's had a very, very strong start to the year. And you're still, well, when you're back below 13,000, you're at 12,869 right now per tonne.
How much of this trade is just momentum? How much of the gold and silver trade is just momentum? It feels like there's an awful lot there at the moment. When it flips, and I don't know what the catalyst could be, it could be something as simple as that. I say simple, as something as significant as that. How quickly could it unwind?
Think of the trade deal between the US and Taiwan and commitment, arguably, from TSMC, reportedly to build another 4 foundries, in the United States. What that would take in terms of you need a lot of copper for that, and that's just one example.
Did you hear the Annabelle interview, though? Annabelle Julius's interview with the TSMC guy? What he said was basically, we're going to do some stuff in America. We're going to do the really high-end stuff. We've got to still continue to do it in Taiwan, though. We can't do that stuff in America because you've got to have all the kind of teams coordinated. So, yeah, we'll do the low-end stuff in America. We're going to continue to do the high-end stuff here.
Did he word it exactly like that?
Almost, yeah.
We will certainly be bringing that interview to our viewers a little bit later on in the programme, so that'll be interesting. And that taps in, actually, to the complicated juggle that CEOs, CFOs have to do right now when talking to the global audience, talking to the US audience, talking about where you expand and why, and how you keep the Trump administration on board, perhaps.
And global political leaders as well, or at least those who aspire to be political leaders, giving a Nobel Prize to President Trump. Did you see that? Machado, of course, he accepted it, so he now has that Nobel Prize. There we go. Coming up, it is the opening trade. Happy Friday, everyone. Certainly happy for President Trump. Futures in Europe pointing currently down 0.2% BDN after fresh records yesterday. We'll bring you the open in the next couple of minutes. This is Bloomberg.
Friday morning, good morning. In a couple of seconds, Tom Mackenzie is going to show you a few numbers, and they are basically red numbers. That tells you that European futures are going lower. And the reason they're going lower, and horses and carts spring to mind this morning, is you've got this sell-off into the end of the US session yesterday. And I think that's basically kind of what European futures are pricing in first thing this morning, Tom.
Yeah, and you'll see if that holds, of course. Currently pointing lower by 0.2%. But in a week where we've had those gains coming through for European stocks and that outperformance in terms of the stock 600 versus its US counterpart, the S&P 500. Today, though, there is a bit of pressure coming through, it seems. Maybe a bit of profit taking given the record high that came through yesterday and the dynamics that Guy was talking about. FTSE 100 futures pointing lower by 0.2%. Basic resources could be a bit of a drag. Energy is going nowhere. DAX futures pointing down by 72 points, a little softer by 0.3%. Anna's looking at some of the individual stocks.
Yes, absolutely. So let's focus on those then, Tom. We'll start from the bottom, ASML. It was in focus yesterday because, of course, of the TSMC numbers. Now Asia has responded to that. Is there more in that trade? We've actually seen one broker upgrade ASML this morning as well, so maybe there's a little more related to that. We will see. Equinor is in focus as well. This is the wind farm business. They've won a ruling to resume the wind project that was halted by President Trump, but just like others in this sector, it's not the end of the story. They're still up against the US administration in their efforts to keep doing wind business offshore in the United States. But it does seem as at least they can continue work on something that they had started already. And the mining and the basic materials story is an interesting one. We do have, as you said, Tom, we're flat on oil prices. Gas prices are up, though, by 6% this morning. We do have weakness coming through in some of the underlying commodities in the metal space. When you look at nickel and platinum and the like, those are weaker. So we'll watch the miners. Guy.
OK, here we go. Time for Friday's session. Europe's going into this session basically looking at the rearview mirror, because we're watching what we saw yesterday, the back end of the US session, and that's going to dictate what happens going forward in the next few minutes, I suspect, here in Europe. So the London market, always quick out of the gate, is a little softer. We're expecting most markets in Europe to be down by 0.2–0.3%. We're not quite there yet. London seems to be maybe holding up a little bit better. These aren't big moves, but I think there's a little bit of arbitrage that just needs to be priced in from the back end of the session yesterday. In terms of what moves us forward, we're going into a long weekend, which is in the United States. There are many risks going into this weekend. Do you need to therefore maybe de-risk going into this weekend as you watch what happens in Iran, what happens in Japan? All of these kinds of factors, I think, firmly on the minds of a lot of portfolio managers this morning. So there you go. FTSE 100 down by 0.2%. IBEX is down by 0.3%. That was the narrative we were expecting. Tom, sectors.
Yeah, to your point, in line. The index is in line largely with the futures messages and the signalling there. Across your sectors, healthcare is at the top of the list so far. Technology not far behind, 0.2%. ASML's doing another bit of lifting for that sector. That stock up 1% on the back of that upgrade then. Healthcare then up 0.3%, tech up 0.2%. Those are the two leading sectors right now. But most sectors are in negative territory, not by a huge amount. Basic resources, again, as we expected, currently is the leading loss coming through for that sector, down 1% because of the price pressure coming through for iron ore, but most notably copper in the session today. Anna, what is catching your eye?
Yeah, just some of that metals trade. I mean, basic resources by far and away the worst performing of all those negative sectors this morning, and some of that obviously explained by the moves that we've seen in the base metal prices. Boliden is over in Stockholm is the worst performer within that sector. That's a base metals business. So whatever is today's driver of the weakness that we're seeing in some of those base metal prices, that is certainly something that is having an impact on markets this morning.
What do you do going into this weekend, though? What does the yen do? Big potential moves there. Jay Foley flagging the possibility of joint US-Japanese intervention. How big a risk could that be? What happens on Iran? Is that for next week? Do I basically just have to track the USS Abraham Lincoln, is it, that's moving out of Asia into the Middle East and keep an eye on what's happening? I don't know. It's fascinating to see. In terms of the points, SAP, Richemont's, this is on the downside, SAP's down. Richemont's backing off after yesterday's move. But then it's kind of a mix of Rio Tinto, some banks and some of the big oil companies just kind of moving a little softer this morning. Yeah, let's talk about these markets then. Patrick Armstrong joins us, CIO at Plurimi Wealth, on set with us this Friday morning. Welcome to the programme, Patrick. Middle of January. Feels maybe like the end of January or even the end of a year. It's been really busy. Where are you thinking about risks right now? What is the risk to the US economy right now, Patrick? Is it to the up or the downside, do you think?
Risk is to the upside. I think Trump, everything he wants to do is create huge momentum going in through the summer, create short-term fixes for all the problems he sees, and will suffer the long-term consequences after the midterms. And I think that's as far as his vision goes. He really wants everything to be great for the summer, so he wants to politicize the Fed, get interest rates down towards 1%. You're going to get tax rebates coming in the next few weeks, and then you're going to get a tariff dividend going into the summer. So it's fiscal thrust, monetary thrust that's not needed, I do think pushes the economy higher, pushes demand higher, and you probably fuels a bit of a speculative frenzy.
OK, yes, I mean, you can pick your metaphor. You talk about a sugar rush. We would have previously talked about a punch bowl, perhaps, and, being liberally provided for this equity party. So what's the risk what tips that over, do you think, into something more negative for stocks?
So the
maybe that's long
Fed,
off. Maybe that's far away.
So my thesis is you need the Fed to cut. You need monetary stimulus combined with the fiscal stimulus, given where valuations are. It's not completely easy to politicize the Fed to the extent he wants to. He might succeed. He may not. You may get the existing governors have their backs up against the wall and they push back against the new chairman about what he's trying to put in place or she's trying to put in place. And without monetary stimulus, the valuations, I think, discount the very positive fiscal backdrop, the very positive consumption backdrop as well. So I do think you need that extra thrust of monetary stimulus that's not needed.
That's interesting. So the Fed is still a key dynamic.
So how many cuts? I mean, how many cuts would be needed then to get to that place that you're looking for on monetary policy, given the fiscal stimulus and that push for lower prices and the
two cuts will be very stimulative before September or during September, by September. Things less than that, I think market's going to be disappointed given where it's trading.
Disappointed? How does that show itself?
It depends on the narrative. So you're going to have Senate hearings as the new chairman gets basically questioned. You'll figure out what he's thinking, and then you'll see if he can create consensus within the Fed. But there's so many other dynamics that are going to happen to have a view about what things are going to be in September. It's almost foolish to think about because there's so many twists and turns on the way there.
So my experience of toddlers is that you give them some sugar, you get a sugar rush, and then things pretty much end badly.
Yeah, so that's what I think.
Yeah, that's my experience, and I think a lot of people's experience of toddlers. Tom has much more experience right now. And not that you give your children sugar. What happens second half of this year? Because markets are meant to be discounting mechanisms, aren't they?
Inflation happens, and the market is so complacent about inflation. So many of my peers are talking about disinflationary trends. Everything Trump is doing, and Trump's the most powerful force in the world in many respects. He gets things done through coercion, through policies. is inflationary.
Yep.
So protectionism, nationalism, stoking demand, stoking monetary stimulus. You have to protect against inflation. And the market says there is no inflation, and there's not going to be inflation for the next decade. 2.3% is the break even for inflation for the next decade. It's going to be much higher.
But if Trump if Trump gets things done and he wants inflation down ahead of the midterms, isn't that also why markets might be assuming that inflation comes lower?
Well, yeah, I actually think we probably are on a downward trend for inflation in the next few months, potentially. But the consequences of all these policies are felt with a lag. And that's when you're going to start to see inflation. There's embers that are going to be burning, igniting, and then you've got a real inflation problem going into 2027, I think.
I'm much more familiar with teenagers at the moment, and teenage parties get definitely out of hand.
More punch bowl than sugar rush.
Definitely more punch bowl than sugar rush. What does the next morning look like?
Well, it's 2022 in many ways that unexpected inflation creates 2022. It kills bonds, it kills long duration stocks, high multiple stocks, and I'm trying to mitigate that by buying great companies that are trading below market multiples. If you look at our global,
give me some names.
Well, I love Alphabet right now. It's trading at a market multiple, great growth. It's funding huge capex from cash flow from operations. I'm short Oracle to mitigate the risk that comes from basically unproductive capex spend. Oracle's funding everything it's doing with debt. I'm short SoftBank, which owns a bunch of non-profitable tech companies hoping for an AI bubble and a SoftBank, not a SoftBank, a ChatGPT IPO. Those kind of things. I love companies that produce cash today and are growing rapidly today. And I like to reduce the risk by selling companies that don't have earnings and are more aspirational and hoping to get them. That's when inflation punishes the multiples on those kind of companies.
So just unpack that SoftBank view, what it tells us about what you think the winners and losers are going to be when it comes to the tech story.
Yeah, the incumbent companies have a much easier path to be winners. People trying to disrupt them and to get into their space face a lot of difficulty, especially like Oracle. They're trying to disrupt some of the Mag 7 companies, the hyperscalers. They're trying to get into that place. But when you're funding everything with debt, and then you get inflation and higher rates and credit spreads go if the economy slows, that just makes it almost an impossible task from a very difficult task. So I really think owning great companies that are at market multiples makes sense if they don't have a lot of debt. Shorting expensive companies that have aspirations but don't have the profits today makes good sense in that.
That fits with we talked about electricity prices this morning, and the fact that CoreWeave and Oracle and companies like this basically going to have higher electricity prices going forward.
It's much more difficult for them to absorb than an Alphabet, for example, could be the argument. So Patrick, presumably, given your short positions, you think that is a 2026 story, that these companies, the Oracles and the SoftBanks of the world, maybe CoreWeaves, get really tested?
I do think so. I think people will see what I'm seeing if my base case plays out. The market doesn't wait for everything to happen. It starts to anticipate, and I don't like to be naked long when I know things are expensive. I like to have nice shorts offsetting my longs, and that's where I'm at right now. So it's a more moderately bullish view than outright bullish.
Where does it leave European tech?
European tech, we actually just shorted STM microelectronics as well. That's getting a bit expensive for us. ASML makes sense to me. It's got the dominant market position, incredible run-up, looking expensive, but those kind of stocks make more sense to me. But Europe, I like defense. I like banks.
Banks are expensive, aren't they? Price to book has gone crazy.
Yeah, I'm sticking with them. I haven't added to them in a while, but they keep growing in my portfolio just because the performance has been so good.
Not rebalancing.
Yeah, and Europe has to rearm for so many reasons. There was a lull looking at a peace deal, and there's not going to be a peace deal with Russia. It's just clear to me. Europe has to rearm for many reasons, and that's going to be structural tailwinds for revenues and earnings.
Does that mean that they're going to have more bonds issued? Just like what is the effect of that?
Well, that's a fiscal stimulus for Europe as well, which is part of the reason that I'm bullish on the European economy. Not incredibly. I think it's going to grow at 1.2% this year, which supports some growth. But, there's bond issues from governments to finance it. The defense companies will probably issue capital as well in terms of maybe even equity as well, but they probably may not need to. But
and is this a world where precious metals continue to do well? And if so, how do you get that exposure? Through the metal or the business?
I don't like gold. Gold, the narrative...
I haven't heard anybody say that for a really long time.
And
there's a but, though.
Yeah, there is a but. We just added Barrick in our global equity portfolio. Our macro fund has 25% of its equities are gold miners. If gold does nothing, the gold miners go up 25% this year. Every day gold stays at $4,600 an ounce. These companies produce huge cash flows, huge earnings. They buy back shares. They'll start paying dividends. And that's with gold doing nothing. if you love gold, you have to love the gold miners, because if gold moves higher, these stocks are geared gold. If gold crashes, they both crash. But the gold miners gold's a speculative asset at this point.
Yeah.
And gold miners are a better speculative
And there's always that
asset.
risk. We talked about this a day or so ago. You know, sometimes when the selling comes, you don't sell what you want to sell, you sell what you can, and gold is very liquid, and so
very
sometimes
liquid,
we see that.
and you've got 100% profit if you held it for a year. It's that'll be a source of funds in the next liquidity driven.
Yeah.
How wide is that window to get exposure to the miners?
Well,
I mean, is that becoming a crowded trade?
I don't know if it is. If you look at the weights in the MSCI world, it's 3% probably in miners as a whole. So gold miners probably are 1%. I don't know if they're crowded. They've not really outperformed gold massively. In the short term, they have. Over the last 3 years, they've underperformed gold. So they're cheaper on earnings. I love stocks that are performing incredibly. I like to ride the momentum. They get cheaper. Like Micron. Every day it goes up and it gets cheaper just because earnings forecasts are outperforming the share price. And same with gold companies.
Final question. If US stocks even go sideways, what happens to US consumption?
Yeah, you're talking about the wealth effect from the stocks. I don't know how much of a source of funds consumption it fuels confidence.
Makes me feel good.
Yeah,
like
it's a confidence
US
factor.
consumer. I look at the latest retail sales numbers.
I don't think it matters if they go sideways. If they go down, then you get the double negative.
And that matters for the top of the K.
Yeah. It matters more for the top of the K. That's a very good point.
Patrick, nice to see you. That was really interesting. Thanks very much indeed. Patrick Armstrong, CIO at Plurimi Wealth. Core 6 looks like this morning. Let's see how those defence names are trading. Rheinmetall a little softer, but not much. ASML is up. I think it's a Morgan Stanley upgrade in the market this morning. Shai's a little softer. Some of the more staple end of the market is a little softer as well with Nestle, but Novo's up. Novo's been really choppy this year and is up quite strongly as well this morning. There's a lot of M&A stories swirling around within the pharma space. Let's get more of an update. Jennifer Creary's here with that.
Hi, good morning. So mining stocks in the red this morning. That's after copper, zinc, aluminium prices all fell in Shanghai and the London Metals Exchange. Of course, that's after Chinese regulators clamped down on high-frequency trading. We can see Glencore, Rio Tinto, Antofagasta, BHP Group all down in the red this morning. Flipping over to a bit of M&A news, of course, that being Kloeckner, Worthington Steel agreed a takeover of Kloeckner, boosting those shares almost 30% off of the back of that news, saying that there's highly actionable synergies between the two companies. Next up, we've got ASML that was in the news yesterday as well, off of the back of that bullish guidance from TSMC. ASML being raised, Morgan Stanley raising the price target for ASML by 40%, saying that demand in China looks, quote, better than feared, up nearly 1% off the back of that news. Finally, we got Close Brothers, RBC upgrading Close Brothers to outperform, saying that the lender has, quote, more fat to trim. Those shares up 8.3% off of the back of that news.
Jennifer Creary, thank you very much indeed on some of the individual stocks on the move this Friday. Coming up with some of the top US banks results out this week, of course. We're going to be unpacking the key takeaways next. Maybe get a nod ahead as well to the European bank earnings story. This is Bloomberg.
Canada's new government began to recalibrate our relationship with China strategically, pragmatically, and decisively. Peu après les élections, j'ai discuté avec le Premier ministre Li. 2 mois plus tard, nous nous sommes rencontrés à New York. En octobre, j'ai rencontré le président Xi en Corée du Sud.
We almost had it. Carney was speaking in English and talking about the relationship between Canada and China. He's in Beijing. I'm not quite sure where he's in Beijing. Maybe Tom can update me. But then, switching to French. And we'll dip out of that.
We could have had Tom with the live translation. I'd have given it an effort, but maybe not best serving.
Yeah,
I'm not sure if that's
our audience.
I'm not sure if that's a forbidden city or not, but Look, it's important. Prime Minister Carney's there. We've got a number of leaders have been over in Beijing trying to cement or at least improve their trade ties with Beijing. We've got Prime Minister Keir Starmer's heading over there shortly as well. And Carney doing something of a reset. They're talking about, obviously, agriculture. They're talking about energy.
Supporting clean energy, which is
Supporting clean energy. I thought it was interesting from the Trade Minister. The Canadian Industry Minister, Melanie Joly, said yesterday, you know what, I'm quoting, you know what, the conversations have been more predictable and stable than sometimes with other countries, including our neighbour.
That's not a big surprise, though, is it? It's been quite volatile, the relationship with Washington.
Yes. Interesting in the context of the history of China-Canada relations. Right, we're going to switch focus now from Prime Minister Mark Carney on the ground in Beijing to global credit markets, which are running at their hottest in 2 decades, prompting some of the world's biggest money managers to warn against complacency. We're joined now by Bloomberg's Helen Durand for the details. Walk us through what's happening in the markets, where the complacency lies.
Everywhere, arguably, from high grade to high yield. You've had a flood of money pouring in for the last sort of 12 to 18 months, and it's basically investors have had to kind of deploy it, and it's basically.
How did we get here? A lot of issuance is how we.
A lot of issuance, but also a lot of money. Yields are high. They've been, it's kind of the best yields that people have seen for, years. So it's been sort of hard to ignore. And also the quality's gone up. So even in the junk market, where arguably normally, where the kind of bad companies are, because a lot of the terrible companies have gone to the private market, the quality's gone up. So actually it's gone up a lot safer. Combination of money and upping in quality, balance sheet is strong.
Spreads to govies, can they get any tighter from here?
It's a good question.
Are they really tight?
I think the view is probably will stay stable from here. If anything, maybe we'll go a bit wider. There is a lot more supply coming. Big tech, a lot of AI, capex that needs to be raised in, and a lot of it will come to the debt market.
But am I getting paid for the risk, I guess is the question that I'm really asking.
I think a lot of people said you're not. But having said that, what else are you going to do with your money? Where are you going to put your money? There's very few alternatives out there.
And there's some big corporates that people note, can raise money cheaper than their governments.
Absolutely.
So we've talked about France, we've talked about a couple of big names on that front. They're still very much the outlier, though, aren't they? That's not... Or is it becoming increasingly a phenomenon?
I think for now it's still, it's still quite rare. But you do see it, as you say, countries like France, where it's been, the finances are in trouble, arguably. Same with the US, massive deficit, where you've got this sort of Alphabet and Microsoft of this world that are, trading sometimes tighter than the govies. So,
this takes us to Jamie Dimon, though. He talks about cockroaches back end of last year. And at the moment, there have been a couple, but there haven't been that many.
So we might need to keep our eyes open for if there are more. Helen, well, thank you for that. Thanks for the update on the credit markets, Helen Durand. But with that thought about cockroaches and where they might lurk, where problems might come in the future for the banking sector, let's talk about the banking sector. Results from Morgan Stanley and Goldman Sachs wrap up a big week of earnings for Wall Street banks. Goldman Sachs blew through expectations for equities trading revenue, posting an all-time Wall Street record of $4.31 billion in the final 3 months of last year. During the analyst call, CEO David Solomon spoke about remaining dynamic on share buybacks.
While the bar for transformational M&A remains very high, we will continue to look for ways to accelerate growth in asset and wealth management. In addition, we have $32 billion of remaining buyback capacity under our current share repurchase authorization. And while we are mindful of our current stock price, we will remain dynamic in executing repurchases.
David Solomon there, of course. Let's bring in Bloomberg's Tom Metcalf. Tom, I feel really bad talking about cockroaches. Guy made me do it. But, this was a positive story coming out of the banking sector, wasn't it, yesterday? So maybe we should linger on that for a moment. What were your takeaways then? Let's do that. Morgan Stanley, Goldman Sachs.
Yeah, certainly from Morgan Stanley and Goldman Sachs, the biggest takeaway is just how strong Wall Street kind of narrowly defined, the capital markets side of the banking business is doing. So both of those results, really stellar shares, really jumped. And as we just heard, the CEO is very, very bullish, and that, across the board strength, but particularly equities traders. And at Morgan Stanley as well, I think their debt underwriting almost doubled. So very, very strong performance. And then it's kind of, as you look back at the whole set of results with JP Morgan kicking them off on Tuesday, it's a bit more of a mixed picture, and moving away from Wall Street to Main Street, I think that's where maybe there's a little bit more kind of downside risk, bit more nervousness. But the basic message is these banks are making more money than ever, and it kind of depends on your outlook, how sort of positive the shareholders are reacting right now.
And Tom, I'm wondering whether the regulatory environment is positive for banks in the US or not, because you've got the focus on credit cards, but also talking, particularly when it comes to underwriting and M&A and deals, of a cut in regulation, and that being supportive. But the regulatory regime is kind of complicated.
Yeah, exactly. There's kind of, Trump takes with one hand as much as he gives, right? So you have seen, because of the deregulation and general animal spirits, let's call it, coming back in, huge boost in business. But then that's one of the big drags, on, for example, JP Morgan. Trump coming out by social media saying you've got to cap your interest rates on credit cards, and that would basically destroy.
Which is not law yet, but it is a proposal.
No, and
some senators are looking at, some lawmakers are looking at this.
Absolutely, a lot of pressure from across the political aisle. But I think the thing that the bankers were saying, and they were quite strong on this, is we see effectively no legal reason for this. We're going to push back as hard as we can. Very strong words, particularly in kind of a Trump era.
If Morgan Stanley and Goldman Sachs did very well, what's the quarter looking like for Barclays and Deutsche?
Yeah, so they'll be reporting kind of early February, really. And with the big investment banking business and big investment banks, the question is, can they actually take any share from these, Wall Street banks? Because that's what I would constitute as a great performance. And it's difficult. We have some analysts saying they expect they can, but then you look at some of these numbers and you're like, Morgan Stanley did so well. They're presumably taking
Did they take money away from JPM?
I think
JPM the loser this quarter.
It does, it's slightly harsh to call them the loser, but yes, they disappointed, at least on the investment banking side. And, their executives were quite clear on that. They said, look, part of that was some of the deals got pushed into 2026, but part of it was underperformance, and it's something they're looking at and not very happy about.
Tom, on European banks, what's the consolidation story for 2026?
Well, I enjoyed my 2025 with lots of sort of more middling deals, I suppose, and it's probably going to continue in terms of I still don't see that sea change that's needed to do something, seismic. So, a UniCredit and Commerce Bank, for example, something that will really, I guess, frighten politicians. But a bit like the US, the animal spirits are there. Already this year we're seeing sort of deals pop up, and I just think it's just going to be a bit more, again, of lots of deals which maybe don't, which are important on a domestic level or for the bank itself. Maybe there'll be some insurance deals and asset management kind of consolidation. But yeah, sadly for me, the kind of dream of, Barclays behind a huge bank is probably unlikely.
Maybe they make money out of other people's M&A, though. That was a big theme in the
you can win on both ends, right?
Story. Yeah. So
bankers generally try and win on both ends. Tom, great stuff. Thank you very much. European banks trade on some pretty punchy numbers now. It used to be that you trade on a huge discount to book, and now that is gone. Anyway. AI could be one of the big factors in terms of bringing costs down at some of these banks in the long term. Near term, maybe having a slightly different effect. Anyway, a new report by Boston Consulting Group finds that companies are expected to accelerate investments in AI this year. Jessica Apotheker is going to be joining us, senior partner at Boston Consulting Group, BCG. That's coming up next. This is Bloomberg.
This is the opening trade. Happy Friday. We are 30 minutes into today's session. A bit of lack of conviction, it seems, across the markets, at least at the benchmark level. European stock 600 currently down just 0.1%. Here in the UK, the FTSE 100 is off by around 0.2%. Basic Resources is something of a drag. It's the biggest loser across your sectors. The DAX over in Germany dropping 20 points. And over in France, the CAC is off by 0.2%. Guy is breaking down the details for us. Guy.
Yeah, more stocks down than up in the stock 600, 340 versus 237. Volume's a little bit light. We're going into a long weekend in the United States. Just think about that in terms of your risk management as you work your way through towards the back end of this session. Let's talk about the leaders. Pharma's doing fairly well. I think there's some B of A upgrades floating around in the market this morning, and it's lifting Nova. I think it's lifting Novartis as well. Siemens Energy is up. Is that the AI electricity trade story that we're watching in the United States? Because in theory, these companies, these AI companies, are going to force through the contracts the generating companies in the States to have to build more gas-fired stations and, you could argue, nuclear stations as well to provide the electrons that AI is going to need. Is that the trade this morning? I don't know, but it's up and it fits. Let's talk about where we're seeing some downside. There's a metals theme that runs through all of this. I kind of... Richemont had a great day yesterday, but it makes quite high-end watches that are made of gold, silver, platinum, etc. It's down by 3.2% this morning, but it did really well yesterday in terms of its numbers. Rio is down, Glencore is down. You are seeing a few wobbles in the commodity complex this morning, and you price them pretty quickly into the metals producers. So that's pretty much why we're seeing what we're seeing this morning. What else do we need to know? Anna.
Yeah, let's get an update on some of the other news flow. JP Morgan is looking to add deal makers in Europe. Executives at the bank expect 2026 to be one of the best years ever for mergers and acquisitions, boosted by lower interest rates, stable credit conditions, and a backlog of delayed transactions. Denmark and Greenland are stepping up lobbying of US lawmakers in an effort to head off President Trump's push to take control of Greenland. A group of US senators is set to meet members of the Danish Parliament in Copenhagen later today to discuss the issue and show support for Greenland's sovereignty. President Trump and governors of several US northeastern states are, as Guy was suggesting, taking an unprecedented step to get tech giants to pay for surging energy prices. The administration plans to direct the country's largest grid operator to hold an emergency power auction today. The plan seeks to address growing tensions over how the nation can supply electricity to power-hungry data centers. Tom.
OK, well, let's get a different element to that story, because TSMC says it will try to speed up the transfer of its advanced chip-making expertise to the US while continuing to develop and maintain its top fabrication techniques at home. TSMC's CFO told us that even with faster transfers, it would still take at least a year for mass foreign production of its leading technology.
We don't look at it this way. It really depends on customer demand. In the US, a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over
Yes.
the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then.
OK, TSMC's CFO speaking to Bloomberg's tech reporter Annabelle Drulers, and of course the run-up in terms of the gains that came through in terms of the capex story for TSMC led to those additional upside and gains for tech more broadly, globally yesterday. And if you are building the picks and shovels and you're building out the data centers and you need the chips to go in them, then what's happening at the adoption level? Let's get some answers and bring in, at this point, Jessica Apotheker, senior partner at Boston Consulting Group, that has been analysing the uptake of some of these AI services at the other end of the spectrum. Jessica, we're talking there and hearing from the CFO of TSMC in terms of the infrastructure part of the AI story. What are you and the team seeing in terms of, at the enterprise level, how much appetite there is for adopting this tech and whether or not that can be sustained?
Well, I want to say that the customer demand that he was talking about is really on the rise and buzzing with optimism. When you see this year's report, so you see the intent of investment of corporates behind AI for next year. The intent of investment is 2 times more than what it was last year, which is just huge. And the other big novelty this year is that people are committed to AI no matter the short-term return. You see 90% of CEOs saying they are committed to continuing to invest behind AI, even if they're not hitting returns this year. So a lot of confidence and definitely appetite behind this technology.
How does that play out sector by sector? How much differentiation is there, for example, in financial services versus energy versus the consumer? Are you seeing that breakdown? Are you seeing differentiation in terms of the pace of adoption and the willingness to invest?
For sure, we see CEOs at the forefront of the AI adoption across every industry, every sector, and also, I want to say, every geography. So there are these CEOs that are at the forefront, but there are some in sectors that are more ahead than others. I'd say exactly as you said, technology, financial institutions, insurance, they're way ahead in terms of absolute level of investment already this year, planning to increase next year. But we do see some sectors catching up. For example, the consumer goods industry that was quite behind this year, actually they declare very high intent of investment for next year. So in general, across the board, optimism, more investment, some nuance there.
Jessica, you said a moment ago that these CEOs are investing with little regard for the short-term return. They're not worried about it. They feel they have to invest. You almost have to spend the money to answer the question as to whether or not AI is going to deliver. Would you describe this investment, therefore, as speculative?
Well, if you see the interpretation of why CEOs are doing that, it's much more because they have confidence in the long-term return of AI than anything else. When you ask CEOs, 60% of them believe that there is confidence in the return of AI on the mid and longer term. So no debate there, that they're in there for the strategic game. They actually believe in the technology. It's not such a defensive game. But there are nuances. Again, you'd see, for example, in the Greater East, much more optimism and much more investment behind growth. What you see more in the Western markets is more of a mixed picture, a lot of confidence up from last year, but also much more of a defensive play and not wanting to fall behind AI. So there's a little bit of both.
So what does that mean in terms of the longevity of this investment? When do they need answers? When does the question about efficiency and return need to be answered by?
Well, I think it is a positive cycle in a company, right? When you see what we see in the research is that when the CEO is confident, the CEO actually spends much more time in being personally prepared to be the chief AI officer of the corporation. We see CEOs leaning in personally, spending that time, and when they do that, they commit more capital behind the AI transformation. They also commit more capital behind training their workforce at scale, really landing that skill set in the organization. And when they do that, you see much higher returns, actually. You see returns, and especially on the growth side, not just on the productivity side. So it is not a question that the returns are not there. They are there, but they take the right momentum in the organization to unlock.
Yes, interesting in your research, Jessica, good morning, that you suggest that this is turning into something that CEOs lean into personally, not just CIOs and CTOs, which is interesting in itself. What do trailblazers look like in this space? What is it that meets that definition, I suppose? Is it to do with the amount of money deployed, or is it the way that they prepare their businesses, they train their workforce to make the most of this technology?
It is that pickup is also what I picked up in the survey this year, is that really the role of the CEO personally is the seismic shift that we see. We see 70% of CEOs saying that they behave as the AI officer of the company. Last year it was much higher on the CIO and tech side. Now, to that, what needs to happen? The first thing that is the unlock is the actual personal attitude of the CEO. It's the state of mind that cascades from the top down. What you see is when CEOs are positive, when they are confident, when they invest personal time, then that actually drives the entire organization behind them. So one number that really struck me was that the CEOs that are trailblazers that you're talking about, they spend 8 hours a week actually training on AI. That's a huge number. That's almost a full day. And then that cascades afterwards in much more capital invested, as you say, also investing behind technology that is more at the forefront, like agents. So it's that attitude that is the real unlock of trailblazers.
And Jessica, when you see Europe versus Asia, which seems to be leading from what your research tells us, Europe, broadly defined, so EU, UK, everything, seems to be behind. Is that a function of sectoral exposure, or is it something else?
Well, they're leading from a confidence standpoint. I don't know if they're leading from an outcome standpoint, but when you see what is true is that in terms of confidence level, in our survey, we see CEOs in the Greater East declaring very, very high levels of confidence behind AI. And as I was saying, that attitude of CEOs is so important for the rest, that the key point here, I think, in Europe is with all of the macroeconomic context and some of the focus that we have, we need to shift that attitude of corporates more towards believing in revenue growth, believing in that AI long-term return, and then that is the momentum that we need.
Jessica, do you have a sense, given the decision-making and given the aspirations of these CEOs and CFOs on the spend around AI, well, who's going to benefit? Is it the legacy providers, the SAPs of the world? Is it the Salesforces of the world? Or is it the Anthropics with their enterprise proposition? Or is it some of the incumbents, the Pigments of the world, offering those new software solutions that are empowered by AI? Where is most of this money going?
Well, like for every new technology, there's a full ecosystem that goes behind it, and nobody has a crystal ball on who will win in that ecosystem or not. What you see, if you make the parallel with the internet technology or the digital technologies, there were both new entrants and incumbents that won. What really matters is the way you engage on the transformation and how deliberate you are on that shift. I'd say from a customer standpoint, from an enterprise standpoint, CEOs are looking for end-to-end solutions that help them break silos between actually technology, data, AI, and that training of the workforce that they need to get to the results. If it's just technology off the shelf, it's just not enough for them to getting the return. So they're waiting for the ecosystem to support them on all of these needs.
Jessica, really useful. Thank you very much indeed. Jessica Apotheker, Senior Partner at Boston Consulting Group. Thank you very much indeed. I'm sure AI will certainly be a feature of the landscape next week when it comes to those attending Davos. Donald Trump will be there at the World Economic Forum. How should executives handle an encounter with the US president in Switzerland? Got a bit of advice next. This is Bloomberg.
We are concerned about that. We think it's probably just too early for that story.
I'm more worried about an overheating US economy than one that goes into recession this year. One thing I'm really struck by is this quarter alone, we have the biggest fiscal impulse of any quarter since the Biden stimulus. And that was in a recessionary context with unemployment at 6 or 7%.
What we're seeing is a stabilization in the labor market rather than a reacceleration.
It seems like, you have to start imagining the unimaginable.
Highlights from a few of our guests this week talking about the risk of, well, what are the risks for the US economy? Is it about a slowdown, or is it, as we were talking about there, about an overheating? And we have had various views on that subject. Yeah. But overheating and risks around inflation certainly coming back into the narrative this week.
Back end of last year was American economy slowing down. The labour market's the big focus. We have moved away from that, it seems. And look at the claims data yesterday, really positive.
Yeah.
You look at what the Fed story is definitely there. But the sense seems to be that Trump wants this economy to reaccelerate, certainly into the summer, so that he's got a chance into the midterms. And it feels like it's politically...
We've had two opposing views on inflation this morning, from Chris Watling, who thinks inflation is going to come down lower, and then Patrick from Plurimi, who thinks that inflation, if not this year, then certainly in 2027, has become a real problem because of lower rates, fiscal impulse, regulatory cuts. It's all going to come to the bear.
When does the US 10-year break out on this? You look at Skylar to try and find answers.
She's got the answer.
Skylar's here.
Yes. I think that's exactly what the Fed is also struggling with, right? We've got all this uncertainty over where the economy is headed. At the same time, you likely have a more divided Fed because you have dovish outliers. You're going to have a Fed chair that probably doesn't represent the consensus and is more likely to have dissents within the committee as a result of that. And you don't really know where neutral is, or, as you get closer to neutral, you get more dissent with the Fed naturally. And so I think that means that rates volatility has to rise at some point because you're watching for data and Fed speeches much more.
Is the focus now fully on inflation versus jobs? Is the labour market concern out of the picture now?
I don't think necessarily completely out of the picture, because you have these dovish outliers that are kind of like bringing that dot down across the curve. And people want a kind of softer labor market because it's good for the equity market, because then you get some more dovish impulse as a result. So I don't think it's completely out of the picture, and it's something that's definitely being focused on.
It's just crazy, isn't it? That's basically that's the narrative. And it's basically that the Fed is the Fed supporting the American people, and kind of, is that its objective, or is it basically just to keep financial assets elevated? And I think we all know the answer to that question.
Well, yeah, and also how connected are those two things? As in,
that's true.
Are we now more dependent on the asset markets running hot to have a strong economy? I would argue it's maybe not as stretched as some people think. There's evidence that we're not as K-shaped, maybe, but it's certainly something to be mindful of, especially when it comes to the U.S., because the average person is much more thoughtful or watching headlines around equity markets, et cetera. So it does impact confidence.
Well, the U.S. might not be as K-shaped as maybe we thought, but President Trump is certainly focused on the bottom part of that K, isn't he? And there's something that doesn't really add up in 2026. You want to run the economy hot, but you don't want inflation that hurts the bottom of the K. So then you're taking all these other policy actions to try and really minute detail limit inflation. I suppose the question is whether he's successful in doing that and then can get his rate cuts.
I think that's quite hard on the inflation side, because if you have strong demand, when you have tariffs being imposed, that's a price level adjustment, and it feeds into the economy more sustainably when you have consumption that's stronger. And so I think that's a very hard thing to think about. What's more interesting maybe is the rotation you're now seeing within the equity market, where small caps are suddenly popular, because there's this idea that growth in the U.S. will be quite strong. You're getting support of that lower kind of bucket. And we're thinking about the tax bill that, it happened last year, but now we're only thinking about it.
Is that just a US story, that small caps, mid caps rotation? I was looking at the MDAX yesterday, some analysis on Markets Live suggesting that the MDAX has not priced in the fiscal push that we're getting in Germany, and that maybe actually there's room in Europe for that kind of story. Is that something we see?
I mean, maybe more so in the equity market than other markets, in terms of you did have a big yield move and a big euro move on the announcement of fiscal. And I think we're actually likely to have disappointment relative to what was announced last year, in terms of there was this expectation you'd get broad spending, not only from Germany, but the other countries. And because these other countries have bigger fiscal concerns, that spending hasn't actually come through. And German spending in itself isn't as stimulatory as originally expected, as in half of it's just going towards day-to-day operations. So we priced in quite a lot relative to the U.S. in particular. I think it's likely to disappoint.
I'm assuming that you're going to spend your weekend just watching the yen. That's the story this weekend, isn't it?
She looks surprised when you see that.
I do have a life. Skylar does have a life.
Yeah. You are allowed a life. You don't have to be on Yen-tervention watch for the whole weekend.
I think it's definitely something we need to be looking at very closely right now, because we are at key levels, because intervention is, they do take opportunities in markets where they can get bigger moves. Because the issue with unilateral intervention is that you can't get sustained upside in the yen as a result of it. You're just kind of presenting a ceiling because you don't have unlimited amounts of yen.
Jane Foley was suggesting for Rabobank that maybe that the Japanese get some help from Scott Bessent, that you get joint intervention.
That would be a game changer in terms of when you do have combined efforts to strengthen a currency, it can be quite significant. Because if you look at the last rounds of intervention, the only one that really worked was the one that you had U.S. inflation data come in and change the story on the dollar side. So if you have something coming from the U.S., you could see a significant amount of move.
Okay, you've just made Guy Johnson's weekend that much more exciting, Skylar, because that's where his focus is going to be all weekend. Skylar, thank you very much indeed. Bloomberg Markets Live. Skylar Montgomery and Koenig, of course. Let's get another view on this, and particularly how US corporate leaders are going to be adjusting to Trump policy, and that kind of ties in to the FX space as well. US President Donald Trump, of course, will be leading one of the largest ever US delegations at the World Economic Forum's Davos event, of course, next week. All kicks off. Business leaders will be, of course, wrangling with the US president, who has one eye on the midterms, as we've been discussing, and those squeezed consumers at the bottom end of that K, of course. Bloomberg's Francine Lacroix, who is no stranger to Davos, will be in Davos next week, of course, joins us around the desk right now. It's going to be quite the spectacle then, Francine. These CEOs are going to have to both court and adjust to President Trump, who's becoming kind of much more interventionist, it seems?
Yeah, so I think the first question, and good morning everyone, is trying to understand what kind of President Trump will get in Davos. So remember, this is his third in-person intervention in Davos, the first time 2018, where he said, look, American first does not mean America alone. So this was someone that was a lot more open to bilateral trade deals, and helping the world. Then comes 2020, he was much more defiant because he was right at the start of his impeachment trial. And then last year, it was a couple of days after inauguration, it was down the line, and he really focused on oil and oil prices instead of geopolitics. So what do you get this year? You get someone who wants to be involved in foreign policy. You have someone that really goes after CEOs. And so CEOs will want to be close, but not too close. There are all chatters of saying, well, if you see the president, do you say, hello, Mr. President, or do you try and wait for an invite? Look, in 2018, he charmed everyone. A lot of chief executives, especially the European ones, didn't necessarily want to go to a reception that he was holding for them. And then the next day, one by one, they were like, he's really charming, and especially one-on-one, he gives you a lot of attention. So, it's going to be an interesting one.
And I suppose how they deal with him in the moment when they get that time, whether that's one-on-one FaceTime or just in passing. We had a great story yesterday that was suggesting what you need to do to charm the president is you go on Fox News and you bring some kind of gift. I don't know if those will be being exchanged in the halls of Davos, but this must be on their minds, what they do with their sort of elevator pitch moment with President Trump.
Yeah, so I hear from a lot of European CEOs, the ones that have been, a lot of the French ones have operations in the U.S. and sometimes feel like they're not given credit enough about how much they're doing in the U.S. or even changing some of the supply chain. So I'm sure if you have your, 30 seconds elevator pitch with Donald Trump, you say, I'm the CEO for that, I invest that much in your country, hoping that then you don't, get taken aim to. Look, I think what happened with the Exxon CEO was really interesting. Because of what's happening in Venezuela. But then a lot of insiders say, they don't want to be in Venezuela. So actually, if he freezes them out, it's maybe better for shareholders.
So last time it was the bank CEOs, wasn't it? In the front row. And he was just like, you're causing me trouble. So, that speech is going to be...
Caroline Levitt yesterday said he will be out giving out, this is quite minutiae, but we're dealing with that now. He'll be outlining housing initiatives at Davos. So I wonder if that'll be an area where markets could move, because he makes policy announcements and markets do move.
There's a Davos. We've got Trump House.
We have a USA house.
Those houses.
Which is outside the Congress Center, so it's out the security zone. I mean, I'm told they have a lot of security and a lot of Navy SEALs that have been hired extra to try and keep that delegation safe. But they basically have back-to-back programming, so we could have a big speech from there from either him or one of the people in the cabinet.
Fran, who beyond President Trump are you most excited to speak to?
Don't make her pick one. They might all be watching.
Give us some names.
I think, look, it's really trying to understand how people are anxious. I think it's the geopolitics. You hear, when you speak to a lot of the oil major companies, they're looking for Iran. We don't know what happens in the next couple of days. And so I think everyone's going to be on tenterhooks to just try and figure out what the next step is, which frankly is unclear for so many. And traffic. No one likes traffic in Davos. And my big prediction is going to be the worst year ever for traffic.
So is everyone going to be late to everything?
Delegation, probably.
Okay, that makes your life difficult.
Good boots.
Makes our life difficult.
We've got an amazing week lined up.
We have.
We're just going to sit and watch.
Francine's going to be doing all the hard work.
You're doing all the hard work. We're going to sit and watch some of the amazing guests and interviews that you're going to be doing as we work our way through the Davos programme. It's coming up next week. Have a great weekend, everybody. This is Bloomberg.